Hello, Facebook friends. Welcome to another edition of the Jack and Bill Show, live from the Beck Building downtown at 400 Travis Street. Woo. Yes, it's after a one of the best weeks that we've had in the stock market in several months. This week we gave a little bit back. Actually, the market hasn't closed yet. We're just 3 minutes, less than 3 minutes away from the market closure, and it looks like we're actually the market is weakening just a tad. So looks like the Dow's down about 0.5%, a little more than that, 170 points. But the market for the last 2 weeks, actually since the 1st of January, has been somewhat disjointed. Oftentimes, that's a sign of a market top, historically speaking, when you have the major indices moving in different directions. So, today we had the S&P up 5 minutes ago, 11 points to 39.26, and then we've got the Dow down 0.5%. The Nasdaq is up nearly 1%, along with the smaller cap Russell 2000 index up nearly 1% as well. So that's year to date through this morning, we were up about 4.6%. I think we ended the week last week up something like 6.2%. So we gave back a little bit. But this is kind of the way it's been, so far this year. The big story this week and last week has been a runaway, really, rise, a losing of control in long-dated treasuries. This has been very painful for people who own high-quality, long-dated fixed income securities. We've got the 2-year note essentially unchanged. The Fed met this week and had their decision. There was no decision, but they did reiterate they're leaving the Fed funds rate at zero until the beginning of 2024. A lot of things can change between here and now, but Jerome Powell tried to reassure the markets with that, and they talk about these policy tools that they have, along with all the speculations of what they can do to contain the 10-year Treasury note yield, which hit 1 3/4 yesterday, Bill. Now, put that in perspective. A low of 52 basis points, it's gone up 3 times from last year. So we ended the year again at 0.9. I think I mentioned this last time. We hit 1 3/4 yesterday. Today, we had a little relief. It closed to yield 1.72%. The 30-year closing to yield 2.45%. I was visiting with a friend last night, and he asked me what he should do about his mortgage. He's at 4.7%. I said, you need to refinance your mortgage yesterday. Or do it tomorrow. I think I said get a rate lock tomorrow. I would recommend that to anybody, because I think that long dated bond yields are going to continue to escalate. That's just my personal feeling. West Texas Intermediate was up pretty sharply today after being down sharply yesterday, up $1.66 to close at 61 and change, I think. So silver closing at 26.29, and that's about it on the market wrap for this week. Yeah, the Dow closed down 234, weakening here at the close. Nasdaq market up 0.75%. S&P up about the same. Gold closing at $17.44, up $9.40 an ounce. Now that had been down, 10 or 11% this year, with all the naysayers saying that gold's dead because everyone's buying Bitcoin. We've seen Bitcoin continue higher, but we've also seen a rally in gold in the last 10 days or so. So with that, William, what are we discussing today?
Before we get into that, I just wanted to mention, the 10-year yield. because we are seeing this back and forth tug of war between growth stocks and value stocks.
Yeah.
And it really is being driven off the 10-year. So on days when you see the 10-year yield higher, you will see declines in the NASDAQ and in the big tech names, because these are long duration assets, like long duration bonds. They get hit the hardest when we see yields go up. So everyone's kind of myopically focused on the 10-year yield. That probably will not change.
Yes, and I might add too, historically speaking, if you add 130 basis points or 1.3% to the 10-year, you typically get what a 30-year mortgage rate is.
Mm-hmm. That's right.
So, okay.
Yeah, I think, this is something that we have discussed in the past, and we will continue just to hammer on this because we do feel that it's so important, and that is looking at alternative approaches to traditional cookie cutter portfolio solutions. And like, for example, Jack and I were looking at the returns on a number of fixed income investments that we hold, as well as the large index, the Barclays Ag. And, the Barclays Ag, that is a representation of the U.S. bond market. And, what we're looking at is something that's down about 3.6% year to date. Okay, these are high quality intermediate bonds. And that's a pretty big hit in just less than 3 months.
It's caught people off guard, Bill,
Really
because people that owned that last year thought that their bond portfolio was doing so well, because last year you had 6 or 7% appreciation in the ag as the yields went all the way down to 1.2% is where the yield on the Barclays Ag got at year end. Yeah.
Yeah, that's right. So, that really emphasizes, the need to consider alternative approaches with fixed income, but also with stocks. So we've been seeing this back and forth action, as I mentioned, and we could be in a sideways pattern with stocks, although, with more and more stimulus, there is an upward bias, and we've said that, but it really does highlight that we need to consider alternative solutions. Now, if you look at this simple graph here, this pie chart is a 60-40 cookie cutter portfolio. 60-40, meaning 60% stocks, 40% bonds. And we call it a cookie cutter portfolio. This is about as simple as you can get. And for the stock portion of the portfolio, it's represented by the S&P 500 index, 500 stocks. The bond portion is represented by the U.S. Ag, thousands of treasuries and agency and corporate bonds. So for people who like low-cost passive investment approaches, this is probably the easiest way you could go about doing it. 60% S&P 500, 40% U.S. Ag. And historically, this has worked pretty dang well.
About 8% a year, Bill.
Yes. So it's easy to understand, low cost. It has the appearance of diversification. As I said, 500 stocks, thousands of bond issues, passively managed, and has done well. Here's the problem. Stocks and bonds are both very expensive. And so with stocks and bonds being as expensive as they are, the expected returns going forward are lower. And specifically with bonds, there's no income in fixed income. So that's one of the main reasons why people buy bonds is for income. But with yields this low, no, there's no income. Very little on a nominal basis, and then after inflation is taken into account, negative on a real basis.
Yeah, if you think about that, Bill, with the 60-40 portfolio, historically you've gotten 10% from the S&P 500, and you've gotten about 6% from the ag. Now the yield on the ag is down to 1.2. So think about that. That means if you hold on to that for the next 10 years, that's approximately what you're going to get.
That's right.
And with the high valuations, the S&P 500, the Vanguard Group, the largest mutual fund group in the world, has forecasted S&P 500 returns to be about 5% per year for the next 10 years. So if you combine 60% of 5, gets you about 3, and then 40% of 1 gets you, another 0.4. So you're looking at according to the Vanguard group, they think that the next 10 years, a 60-40 mix would make you less than 3.5% per year.
That's phenomenal.
When historically, that means before inflation's taken out, where historically you've gotten over 8. But we've got a little solution here to discuss.
We do. And the other thing about the cookie cutter approach, these indexes, the S&P 500 and the U.S. Ag, they change over time. And we've seen some pretty dramatic changes in the composition of these indices in recent years, or I should say in the last 10 years. All right, so the S&P 500, if we look at the composition of it, we see a very high concentration in one sector, technology. So the performance of the S&P 500 has been dominated by the large cap tech names. Like if you liked energy, for example, you will be woefully underweighted in energy exposure if you're just buying the S&P 500. Now, for the ag, we see an index that has changed as well. And so right now, the ag is dominated by Treasury bonds. It's almost 40% U.S. Treasury bonds. And we've been talking about, the dangers of investing in Treasury bonds just because yields are so low. So that is not necessarily where you want to be right now. So here's the solution that we have been preaching, and we're going to continue to pound the pavement on it, or pound the table on, I should say. Now, again, this is not the be-all, end-all. This is a simple illustration. And so we took the 60-40 cookie cutter portfolio and we modified it into 60-20-20. So we still have 60% exposure to stocks. We have 20% exposure to bonds, and then we add in this new category, alts. Now, we need to spend a little time defining what this is. It's basically anything that does not fit neatly into these two categories, stocks and bonds. And alts can be alternative investments such as precious metals, timber, real estate, real assets. But it can also be alternative investment strategies, things that you find in the realm of hedge funds. For example, long-short investing or managed futures. And there's a whole gamut of strategies out there that are available now.
Business development companies.
And so we're finding that by including alternatives in this portfolio mix, what we're doing is we are enhancing the portfolio. We're improving its performance by reducing risk and improving performance.
Usually those two things don't go together, Bill.
They usually don't. You want to elaborate on that, Jack?
Well, this is optimization theory based on Nobel Prize winning theory in economics in 1958, Drs. Harry Markowitz and William Sharpe. So if you look at these different asset classes, you look at, essentially there's 3 variables: the historical return of stocks and bonds and alts, and then the historical risk quantified using standard deviation and a normal distribution curve. So standard deviation, or sigma, is the Greek letter used to identify standard deviation, tells us how things vary about its mean. So if in this case, we're talking about annual returns. You're getting me out into the weeds a little bit, William. But if you on the y-axis, if you have return, and on the x-axis, you have risk, and then there's this thing called an efficient frontier where we optimize a client's portfolio. That is, for a given level of risk, we maximize return, or we can target a return and minimize risk. And then with the inclusion of the alts, the curve actually goes higher, meaning higher return, and the risk structure stays exactly the same.
More return per unit of risk.
That's exactly right.
That's a win-win.
That's exactly right. So you can actually add risk to your portfolio. You can actually you reduce, you add more aggressive asset classes and reduce the risk of the portfolio. So if you had a portfolio that was just stock and bonds, if you had a portfolio that was all bonds and you added stocks to it out to about 20%, you would actually be reducing the risk of the portfolio. So with the inclusion of alts, and alts are so diverse, it's like you said, William, another definition. If you think of owning cash, stocks, or bonds, now think of anything that is not that. Okay, like shorting stocks or bonds, market neutral, long, short, algorithm run programs, real estate, sophisticated hedge fund strategies. When you incorporate a lot of these things into the pie, we do increase return and reduce risk. An example of that might be, we mentioned, business development companies. When you hear the term business development company, you probably think of something far different from actually what the definition is. But these are companies that work alongside private equity to make adjustable rate loans to mid-market America, where we got so regulated, I think over-regulated after the subprime crisis, that commercial banks who made 85% of these loans essentially quit doing it. So you had these business development companies that came about, and Bill and I invested in some of these this year after the pandemic that were yielding more than 15%. And we don't think these were high risk investments. With the inclusion into our portfolio, they actually reduced risk, and we had sharp appreciation in these things as well.
Well, the thing about what we're discussing, and it does sound very academic, there is an academic basis for this, but we always have to share the disclaimer that there is no hard science behind this. This is not like physics. Okay, this is investing is really more of a social science, like economics. And we like to explain it with the analogy of a chef in the kitchen. And so as we get to know a client and understand their goals and objectives, we craft something that's customized for them. And think about the chef mixing a gumbo, right? We're going to throw in these different ingredients, things that may not taste good on their own. But when you add them together, it makes a delicious meal. And so some of these things in isolation won't look very appealing. But when you add them in together, it can really enhance the whole portfolio. But you can't just jump into any old alt out there. Jack and I have learned a lot over the years through trial and error and getting to know these strategies and how they work and how they complement one another. It's a whole new world out there. A lot of these strategies were unavailable to the public. They were the domain of high net worth investors and institutions until about 10 years ago, when they started to come out in mutual fund formats. So now we can get access to these sophisticated strategies through 40 Act mutual funds.
Yeah, and I see you mentioned alt bonds as well. We've mentioned this before.
Well, before you start, we've talked about the alts, but Jack, why don't you talk about how we've been investing in these stock and bond categories, how we've been moving away from
we've gone from the S&P 500 being very top heavy in tech, and Bill said earlier that's a long duration asset. So we've been finding areas of the market that really kind of an evolution. When the pandemic happened, we rotated into a fund actually for most of our clients that had a beta of more than 2. So then,
You better explain that.
well, that means that if the S&P 500 goes up 1%, your fund is going to go up 2% or more.
Mm-hmm.
So then we were in a fund that essentially went up 100% in 100 days. And then we thought that had gone too far. It's actually kept going. It's up about 20% this year with the market up 4.6. But we rotated into an income fund. We've had that gentleman on our show, actually. A go anywhere income fund that was 60% in bonds and preferreds. But we consider that as equity money. And we interviewed this gentleman October the 31st, I think, if that was a Friday. And his fund is up like 40% from there.
And you can find that interview on our website.
Yes. So we still own it and still like it. And we've had a heavy weighting in it, but we've moved into things like we've moved away from growth. If you think interest rates are going to go up, you don't want to own things like Tesla and NVIDIA and ARK funds and things like that. You'd rather own deeply discounted closed ends, small cap value, international, where the valuations are lower than the U.S. And I like that which is scarce, which is yield. We own some pharmaceutical names that we think have a ways to go. We like energy. We like financial. We like some of the financials. We're not crazy about most banks, but things. So we've done that. And then in the alt bond category as well, I'll give you an example. I was talking to someone on the phone yesterday. We have a 5% weighting in a security that comes due in 2 years. It's what's called a baby bond. This company is a fast-growing Los Angeles-based broker-dealer. Their common stock has gone from about 20 shortly after the pandemic all the way up to 57. They raised their dividend, paid out a special dividend. So, that showed us the health of the firm is doing really well. We bought their baby bonds, which trade like a stock at $25 a share. That we bought them cheaper than that, but we're still buying them. And this is a 2-year security with a coupon of 7 3/8%. I actually bought some of that today, Bill, for a new account that came in.
Are you going to find that in a index?
No, sir. No, because these are smaller offerings, and the Vanguards and the Fidelities can't even buy them because, or even.
If you're passively indexing, not only are you exposed to risks that you can control, but you're not getting access to things out there that are more appealing right now.
Yeah, there are some of the bond fund groups out there. There are bond funds that have $40 billion in assets, and if they bought the whole offering, it would not be significant to their fund. So we've got the ability to sniff out some of these things, spend some time with research, and make our clients' portfolios. We've actually done this shift, which is ever evolving.
Yes.
Right, Bill?
It's dependent on market conditions. This doesn't account for market conditions. If the market is expensive, too bad.
And we've gotten creative. We're just not burning steaks and overcooking our chicken. We're throwing a lot of ingredients in the pot.
I've been told that grilling is cooking. I disagree.
Okay. What else? Well, in the sports world, we've got some real sports again. This is crazy. My alma mater, the Virginia Military Institute, is nationally ranked and 3-0. I think they're playing Samford this Saturday. March Madness is going on. They're playing it all in one location. And ordinarily, every team plays on Thursday and Friday, and then they play another round. And by the end of the weekend, you're down to the Sweet 16. They start with 64. LSU is playing St. Bonaventure. William, I'll give you a clue. Do you know where they're located?
No clue.
St. Bonaventure. I found this to be interesting. They're north of New York City, along with another New York basketball team that made the tournament, Colgate. What struck me about these two teams is they only played about 17 games this year, where a lot of their opposition played, 30-something games. So it's been very bizarre. All of the teams arrived and had to go through this intense COVID protocol, all of them except one, and that was the previous. We didn't have a national champion last year because COVID shut it down, but the prior year, 2019, University of Virginia won. And they're the only team that didn't get there on time because they had players that caught COVID. So hopefully they're there now. Hopefully they're going to be able to play. LSU is an 8th seed out of the 16 seeds in 4 different brackets, and they play St. Bonaventure, which is a 9 seed. If they win that, they've got 1 seed Michigan next.
Yeah,
the other
LSU's bringing the big bets.
They are. They really they almost beat 2 seed Alabama to win the SEC championship. Hopefully, they're going to play in this tournament like they did at the end of the year. The other big news, William, did you hear the news about Drew Brees?
No. What about Drew Brees?
Drew Brees has retired. Came out and put this video. He put this video out of an intense workout that he did, and he made everybody sit on the edge of their seat with bated breath, thinking that he's going to be like his pal Tom Brady and come back for another year. But he announced he's retired, wants to spend time with the kids, and within 24 hours, he got a broadcasting job.
He wants to revitalize Six Flags in New Orleans.
Well, I think that's about it, Bill.
All right.
But I don't think I'll be going to Six Flags. But I might watch Drew Brees do Notre Dame games and Sunday NFL. I don't know.
It will be lovely.
It will be lovely. Well,
all right. We'll have a lovely weekend until we see you again.